But here we are. It's 10:03 Tuesday morning, May 21st, and we've got just a couple more webinars for May, or excuse me, for Tuesday and for May. So we've got today, and then we have next week, the 28th, and then we jump to the. No, I'm sorry, we don't have a webinar on next week, the 28th, because it follows a holiday. So this is our last Tuesday weekly webinar and our last webinar of May. So our next webinar will be June 5th, and that will start our new Wednesday schedule. So I hope that works out for everybody. Just a little bit of repositioning here for us for efficiency. So I hope that it's all in the hopes of making a better process and product for you. Today we're going to talk about some proposed changes. For the past few weeks, I've been talking about the changes coming out of the proposed tax law changes that came out of the White House back in March. So we've been at it for a while now, talking about this, and I know that it's talked about on other channels. People have been, we've been talking one-on-one with folks. They'll hear the webinar and they'll say, hey, I heard this over at this channel, or I've read this in this article here. And I was having a conversation with some of the folks from the Slott group, and the feeling is that there is not much traction for these proposals, which is a good thing for now. This, again, not a political statement, but what I want to, the reason that I'm sharing with you these proposals in detail, and I'm sharing the actual document with you, and we'll get into that during the Financial 15 segment, is because I really want you to see the kind of thoughts that are coming out of our leaders in Washington and where we could potentially be heading down the road in some way. So I'll talk about that again during the Financial 15, but it's important because remember my objectives for you for these webinars. It's not just for entertainment. I hope I can be entertaining to you, but my goals are to inspire you to make changes, to open your mind to different ideas and ways of thinking about planning and investing. I want you to stay educated so you feel confident in the plan and strategies that you put in place, and I want you to stay updated. It's really, really important. You always hear me talk about updating your plan. You should update your plan every year, but you should spend a little bit of time. You don't have to spend an hour a week. I would love it. And for those of you who join me every week, and we spend an hour together, one-on-one, so to speak, I really appreciate that, and I appreciate all the great feedback, and it really encourages me. It's been over 4 years now that we've been doing this every darn week, just about. And I never get tired of it. Sometimes I get a little disappointed when, like next week, we don't have a webinar. But there's a few things I love about it. I love delivering this material to you. I like the feedback I get from you. I like hearing from clients. Hey, I feel like I see you all the time because I see you on YouTube, or I hear you as I'm doing the dishes or my chores or whatever. But that communication is just so important. So be inspired to make changes, open your mind to different ideas and different ways of thinking about planning and investing. Stay educated and stay updated. Those are my goals for you. So let me know if we're reaching those goals. I'd love to hear some feedback from you. I love it. I wrote God morning. All right, God morning, everybody. I remember wrote good morning, but I'll say it again. Let's write it here. All right, let's talk about our slot reports. Let me share with you our slot updates from this great organization. I know I really rave on these people, but I got to tell you, just so much. I had a great conversation with Andy Ives last week. We were talking about I got an email from a client about upcoming changes to. Good morning, everybody. Hi, Emily. Emily Wheeler is with us this morning, everybody. Good to see you, Em. Don, David, hi. I'm not going to call out everybody. Only there's a few of you, but good to see everybody. So anyway, I had an email from a client. Really, really great email from their CPA, forward-thinking CPA, which we really like. I have great respect for anybody who's completed the CPA training, but you've heard me say that many CPAs are rear window or rear view mirror driving, right? They only look at what's been done in the past and then kind of reconcile what you've done with your tax return. So I'm always really excited to connect with a CPA who does some tax planning and is forward thinking, and that's what this email and article was about, it was an article or newsletter that was shared, and he talked about some upcoming changes, and it sparked a conversation with the Slott group for me, which is always great, and maybe we'll make that a topic of an upcoming webinar. But today we're going to talk about what you need to know about community property and your IRA. So most of you here are from Pennsylvania, New Jersey, and other areas that are not community property, but we do have clients who reside in Texas, specifically Arizona, California, and anyway. So it's really interesting, the reach of YouTube. We've had many, many clients from all around the country in the past 12 to 18 months, and that's really interesting and really exciting. And we always encourage you to come visit us if you'd like. And if you're in warmer climates, maybe we'll come visit you in the terrible winters we have here. But let's talk about community property. And this is written by our friend Sarah Brenner from the Slott group. And Sarah writes, what do you get when community property mixes with your IRA? Well, you will discover that the results can be confusing. Here are some facts every IRA owner should know. Community property states, let's talk about the states. The community property system has been adopted in 9 states: Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. Alaska has adopted an optional community property system. Are you off the hook when it comes to community property if you currently live in another state? Not so fast. Society is increasingly mobile. It is not uncommon during a lifetime to move to and from community property states. For sure. We see that all the time with folks entering in retirement and trying to figure out where they want to live. Sometimes it's family reasons or tax reasons or both. Good morning, Keith. So let's talk about how community property works. Community property is everything a husband and wife own together. In general, this includes all money earned and property acquired during the marriage. How do your IRAs fit in? Let me move this up here. Assets held in an IRA will be community property to the extent that contributions were made to the account and earnings accrue during the marriage. It's important to keep in mind that community property rules can vary from state to state. For example, California community property law is not the same as Arizona community property law. When are community property issues likely to come up with your IRA? Well, generally, there are 2 significant times where you might encounter these issues as an IRA owner. When it comes to determining who gets your IRA after a divorce or death, community property rules will come into play. You know, I used to do some work in divorce planning. I was a certified financial divorce analyst, certified divorce financial analyst, CDFA, for many years, and I worked in divorce cases, and I just stopped doing it because I did not like it. But I got into it because a friend had asked me to, and it was a new experience, so that's always good. But typically, this can be these, where properties are developed, earned, grown, can really have an effect on distribution at divorce. So it's really an interesting issue. But let's read this paragraph about divorce. In community property states, a spouse may have a community property interest in other spouses' IRAs. By doing a trustee-to-trustee transfer, this interest can be moved from one spouse's IRA to the other spouse's IRA after a divorce without negative tax consequences. You will need a court order for this transfer to be done. Now, this is why Sarah talks about this. This is important because people just don't think about these things. We've had very, very smart people make bad decisions when it comes to transferring assets, especially when you're in an emotional thing like divorce, or sometimes it just happens. I famously had that attorney who contacted me, a very, very good estate and well-educated estate attorney who transferred an entire estate from an IRA into an estate account, which made the whole thing a taxable event. And that might be shocking for you folks who are always on this webinar and know that you've got to be very careful of how you transfer IRAs. But Sarah's talking about a trustee-to-trustee transfer. What a person might do to just say, okay, well, especially in a heated divorce situation, let me just distribute these IRA assets. I'm going to write him or her a check, or that other person a check, and be done with it. Well, you've created maybe cascading tax consequences for yourself, and maybe even a higher tax than needed to be paid on those assets. So when you're talking about distribution of an IRA, that can typically be handled by with just the divorce decree or oh goodness, I forget the name of the document, but there's a document that the name's escaping me right now that tells exactly the property that divides up the property, and it's an agreed upon document. So with the divorce decree and the other property settlement agreement. The property settlement agreement can be done typically to divide an IRA. Now, with a 401k or a retirement plan, you need what's called a qualified domestic relations order, or a quadro. But anyway, the thing is, you want these things to be done as a direct trustee to trustee transfer. So that is transferring it from, say, Schwab to Fidelity, or Fidelity to Schwab directly, and not writing a check and redepositing it. So that's a really good point from Sarah, because if it's done via trustee to trustee transfer, then there is no tax involved. There's no tax on that transfer, and it's only taxed at distribution. And if one spouse transfers it to another spouse, and then that second spouse decides to transfer, it's going to be taxed at his or her tax rate. Naming IRA beneficiaries. Since community property law can dictate who gets your IRA after death, it must be taken into account when you name a beneficiary on an IRA. In a community property state law may recognize your spouse as the beneficiary of some or all of your IRA. Therefore, you may need to get your spouse's written consent to name someone else as the beneficiary of your IRA. We've even seen these documents in non-community property states where it's a requirement. Notarization is sometimes required on rollovers or change of beneficiary designation forms. Some IRA custodians have beneficiary designation forms with language for spousal consent to name a non-spouse beneficiary. Others do not. Even if a beneficiary designation form does include spousal waiver language, some experts caution against relying on it. To be sure that all goes as planned, the safest approach is for you and your spouse to each have your own separate counsel for an experienced attorney to draft the necessary documents. So let me read that over again. So to be sure that all goes as planned, the safest approach is for you and your spouse to each have your own separate counsel and for an experienced attorney to draft the necessary documents. Expert advice is needed. Now you know that community property can raise some complicated issues where your IRA is concerned. It is best to be prepared. If you have questions about how community property rules affect your IRA, a good place to start is a consultation with a knowledgeable financial or tax advisor who knows both the IRA rules and the property transfer rules. Great point. I talk often about putting together your retirement team, so you should have what I think is your financial planner should be a CFP, a certified financial planner, for all of the education, ethical, proof of knowledge kind of reasons. Should certainly be, the CFP program is a robust program for sure that often takes several years to complete. About 50 to 60% of the people who take the exam pass. There's a high level of proficiency required, so you want that level of education, proficiency, ethical requirements, and ideally, if you're nearing or in retirement, you want somebody who focuses on retirement distribution planning and tax issues around that. You want a qualified CPA. I think your tax preparer should also be a CPA for all the reasons that your financial advisor should be a CFP, in my opinion. So it should be a CPA. Again, ethical, education, proficiency requirements, and you're going to need at least one attorney to help you with your estate, drafting your estate documents. But if you're, if you have elderly parents, or if you're anywhere above 60 yourself, I think that person should be a elder law attorney to help plan for the time that you're going to be elderly in your lifetime and all of the things that come with that. And you may need other attorneys if you're going through a divorce, if you have real estate, if you have businesses, things like that. But it's important to have that team together. Net unrealized appreciation and qualified charitable distributions. Let's talk about this. This is also Sarah. The question came in: I need guidance on a new client with the following information. They are age 55. They have a $700,000 employee stock option plan. ESOP in a company that he separated from over 10 years ago, and he wants diversification. Since he separated from the company over 10 years ago and is now age 55, would he be eligible for the following? Have the ESOP transferred to a traditional brokerage account, pay income tax on the cost basis, pay no early withdrawal 10% penalty, diversify the stock, and pay long-term capital gain tax via the net unrealized appreciation tax break provision on the appreciated value. Sounds great. If you could do it. The answer is, that's Eric. The answer is, hi, Eric. If there is a highly appreciated company stock in a plan, it is always worth at least considering the net unrealized appreciation strategy. That strategy allows long-term capital gains treatment on the appreciation of a plan-held company stock that is distributed in kind from the plan to a non-qualified account. The cost basis is included in taxable income, and any appreciation after distribution is subject to the standard rules for capital gains tax treatment. To qualify for NUA, there must be a triggering event. Both separation from service and reaching age 59.5 are triggering events. You must also have a lump sum distribution. That means that all funds in like plans must be emptied in 1 year. Any distributions taken after the triggering event but before the year of the lump sum distribution would kill the opportunity to do NUA. Also, some ESOPs, especially with privately held companies, may impose restrictions on distributions or on the period stock can be held outside the ESOP in a way that makes the NUA tax break impossible or limits its advantages. You mentioned that the individual is now 55, is age 55 now, but separated from service 10 years ago. That would mean that the cost basis would be taxable and subject to the 10% early distribution penalty. The age 55 exception only applies to those who separate from service in the year they reach age 55 or later, and that is not the case here. Hopefully this points you in the right direction. Any potential NUA transaction should be discussed in detail with the client. There are many nuances and finer points that should be addressed thoroughly. We like to say that NUA is an art and not a science. You know, this is such a great example of the power and the resources we have of the Slott Group. I know it sounds like that I'm constantly, putting forth a commercial for this group. But if you're a financial advisor, we have several financial advisors now who listen to this broadcast as well, thanks to my appearance on the Advisorist broadcast about a month or so ago. But if you're a financial advisor and you're not, and you work anywhere near anybody who's facing or in retirement, and you're not part of the Ed Slott Elite Advisor Group, you should absolutely not consider it, but do it immediately. Because NUA, net unrealized appreciation, is one of the first. It's a great opportunity to save significant tax for some folks. But it has to be reviewed thoroughly, and there are trip points along the way. There are triggering events, and we refer to them as the NUA light is on, is off. But there are things that can trip you up along the way, and sometimes it makes sense, a lot of sense, and sometimes it doesn't. But the taking advantage of the experts in the Slack group, it's like having a team for me. It's like having a 4-person of some team of some of the best tax experts sitting in the room next to me. Just on an ongoing basis, including Ed himself, Ed and his analysts. So I can't say enough good things about it. So the next question, if the estate is the beneficiary of an IRA, can the estate do a qualified charitable distribution, a QCD, with the year of death RMD? Sarah writes, it is possible for some beneficiaries to do a QCD from an inherited IRA. However, it will not work for an estate. That is because to do a QCD, you must be age 70 and a half or older. An estate cannot satisfy this requirement. Very simple. It's a non-person, just like a trust. They can't reach that age, therefore cannot do a qualified charitable distribution. Okay, that is our Slott update for today. Let's talk about investments. So first, I'm going to talk about the performance of last week. It was a really great week again. The Dow Jones Industrial Average was up a 1.35%. The S&P 500 was up a 1.6% just for the week. NASDAQ was up 2.15%. The MSCI World Index, I'd say every week, that is the global stock market, excluding the United States large companies. That was up 1.62. The emerging markets, smaller companies, or smaller countries, I should say. Not small geographically, but smaller economically. Anyway, that index was up 2.72%. Europe, Asia, and Far East was up 1.61%. So this is as of the week ending May 17th. Even the bond index was up again, 0.57%, down for the year, still at 1.40%. But all the other indices, the Dow Jones Industrial Average is up 6.9% for the year. The S&P 500 is up 11.8% for the year. The NASDAQ is up 11.47%. And the international indices, wow, most of them are at about 8%. The small size companies internationally are up just 4.52%. So some really good growth last week, and we're going to talk about what triggered that growth. So we talked already about the producer price index because that came in before the webinar last week. But I'll remind you that the producer price index rose 0.5% month over month and 2.2% for year over year. The highest rate since April 2023. And then we had the so touch higher than expected. Then we had the consumer price index. So remember, the producer price index is the cost of producing things, basically. Consumer price index is the cost of buying things for most of us. The CPI, that came out last Wednesday, I think. The consumer price index rose 0.3% month over month and 3.4% year over year. That was just a bit below the previous month, so that's a positive. The analysts' rate cut hopes rose on this report, but one report doesn't make a trend, and we caution against overreaction. But the market reacted, right? However, after a string of hot inflation reports, so higher than expected inflation reports, it was positive to see a cooler one, and the economy doesn't seem to need a cut in rates to continue to grow, making it a good environment for stocks potentially. So that's a really, really good point that they just made, and that's from our internal analysts from Cornerstone. The economy is still chugging along rather nicely in most areas. We're seeing some slowing, but it doesn't seem to need these rate cuts to grow, even housing and whatnot. But and certainly any glimmer of hope seems to be driving up the market significantly. Retail sales did slow, so the consumer slowed spending in April with sales coming in flat, right? They just didn't grow at all versus an expectation of 0.4%. Let's see, so excluding autos and gas, sales fell 0.1% month over month. So taking out from that report autos and gas, the index actually fell 0.1%. Still small. It's a small fall, considering the increase that we still have in interest rates. So the analyst writes, as expected, the consumer appears to be slowing down, with retailers also noting a slowdown in spending among some cohorts. However, the American consumer is not falling off a cliff, and a slowdown was needed to bring inflation down further. This inflation is likely to be with us for a while, folks. I keep saying that. Mark Bynum, like Attleboro Wealth Management, sitting here, our feeling is that we're likely not going to see rate cuts, probably not until 2025 at this point, maybe by the end of the year. But I'm really pleased when I look at growth that we've had so far this year: 6.9% in the Dow, 11.80% in the S&P 500, 11.47% in the NASDAQ. In the environment that we're in this kind of cooling environment that we're in, right? The Fed is keeping interest rates high. They keep pushing back the discussion about cuts. It's really impressive to see the resiliency of the markets. So what do we have coming up on Wednesday? We have the FOMC meeting, so the Fed minutes from the meeting, and we'll see what they have to say. We have Friday with durable good orders. So durable goods are goods meant to last 3 years or more. We'll see what that looks like to give us a gauge of what those orders look like, and maybe we'll see some more slowing. All right, it was really the only analyst report that I thought was a really good report from Empower, just really entertaining. more than anything. But they were just talking about two different indicators and how they're kind of they use the example of Ghostbusters with crossing. You can't cross streams, and they use in their report they were talking about two indicators and how they're kind of crossing, and that usually triggers a recession. But they first crossed last year, and we haven't seen that recession hit yet. So that was an interesting report. I'm just trying to find there's my BlackRock. So what was interesting about BlackRock is they wrote they write, we stay dynamic on a strategic horizon to take advantage of sharp valuation shifts, right? So that's just an intro, but they write, we go overweight emerging market stocks for the first time since 2020. So they're doing a tactical shift to those emerging markets that I talked about earlier. So smaller economies around the globe. Usually international, right? Because obviously internationally, because we're a large economy, but so internationally outside of the U.S., but emerging markets. So BlackRock is saying they're overweighting emerging markets for the first time since 2020. Does that mean I'm saying that you should do that as well? No, that's not what I'm saying at all. I'm not a follower of tactical allocation like that. And in fact, the last time BlackRock did this was during the pandemic. Obviously, they overweighted emerging markets in the European markets, thinking that they were going to come out of the recession better than we did here in the U.S., and it did not work out well for them. I'm just giving you some insight on what some of the largest and most well-funded analysts are saying around the globe, and certainly BlackRock is one of them. Now it's time to go into our Financial 15. So this is a Financial 15 segment of our weekly webinar. So for the first half an hour, we talked about some market updates and some updates from our Slott group. And if you'd like to go back and review that webinar, you can find it on our YouTube page, on our weekly webinars, under weekly webinars, under the same title as this one. And then this Financial 15 segment is our financial planning topic. So we talk about some really important updates from the Ed Slott group that has to do with IRA distributions, tax law, tax code changes. Then I do a market update, and then we do a financial planning strategy or something important to your plan. And today's Financial 15 is the proposed increases to capital gains taxes. So if you haven't already, please hit the like, notification, and subscribe button so that you never miss a new video. And we post 1 to 3 videos a week, depending on how long I go with these Financial 15s, because sometimes they're 15 minutes and sometimes they're a little longer than 15 minutes. So we break it down into smaller segments so that you have a true Financial 15. But again, in this section, we're going to talk about proposed increases to capital gains tax rates. So first, I'm going to talk about what is capital gains tax. So I'm going to come over here and I'm going to pull up this sheet here. Now, this is a 2024 tax planning document. You can find that at attleborowealth.com. That's attleborowealth.com. And you can go to the, I'm going to show you exactly where you can pull this down. Here we go. Here's our homepage of our website. Now you can see, you can go to Education and Resources, click down there, go to this slot corner, hit the slot corner, and that's going to take you to the page that's dedicated to the Ed Slott group. And down here, I'm scrolling down, you can access your free tax planning documents. And that orange, you can see it right there. The orange chart that I'm referring to is right in there. So I hope that's helpful. You can download those easy peasy, as they say. So today we are going to focus on increases at capital gains tax. But first, we're going to talk about what are capital gains tax. So we're talking about long-term capital gains, or what are called qualified dividends right now. And that lives on this side of the chart here. And it's a different calculation than marginal tax rates. You know, we hear about these tax brackets for income. Well, currently today, these are different. So what you see here is that if this is based on modified adjusted gross income. So if your income, if you're married, filing joint, and your income is from $0 to $94,050, you actually have a 0 capital gains tax rate. If you're single, that's cut in half from $0 to $47,025. You're at zero capital gains tax rate. When you cross over here, 94,051 to 580,750, you're at a 15% capital gains tax rate. So that's anything for long-term capital gains. That's anything greater than 1 year, held 1 year. So if I bought the S&P 500, let's say right now, May 21st, 2024, and I sold it next year on May 22nd, 2025, then I would qualify. I would have held that for 1 year. I would sell it, and if I had gains, I would be taxed at capital gains rates, 0, 15, or 20. I'm going to talk about what the asterisks are. If I hold it for a shorter than 1 year period of time, it's taxed as ordinary income, and ordinary income falls in onto this side of it, so it's taxed just like you earn it. Today we're talking about long-term capital gains and qualified dividends, and specifically capital gains. But these are the long-term capital gains and the qualified dividend rates. So 15% you would pay if your income is here for a married filing, jointly couple. Again, if you're just listening to this, it's $94,051 to $583,750. If you're single, that band, let me just erase this so you can see it. That band is from $47,026 to $518,900. And let's see this again so you can read it. If you're over for a married filing joint couple, if you're taxpayers, if you're over $583,750, you pay a 20% capital gains rate. And for a single filer, if you're over $518,900, then you're at a 20% capital gains rate. Now, what do these asterisks mean? Well, follow me down here. I'll make this a little larger here. We're right here in this box. The asterisk says the 15% rate is effectively 18.8% for those subject to the 3.8% Medicare surtax on net investment income. I'll share with you in a moment what that is. The top, and now if you're at 20%, the top rate is effectively 23.8% for those subject to the 3.8% Medicare surtax on net investment income. So where is the discussion about net investment income? Here it is. Now, here's the description of net investment income right next to it. The top rate, now we're talking about these rates here, so you can just disregard this. Medicare surtax on net investment income, those with modified adjusted gross income at thresholds of $250,000 for joint filers and $200,000 for single filers, just like I said over here. All right, good. So you're understanding capital gains tax as it lives today. Anything greater than 1 year holding period. So again, you buy the S&P 500 today, May 21st, 2024. You hold it until May 22nd, 2025. And any growth that you have, let's say it doubles. You buy $10,000 worth of the S&P 500. It doubles, and now you have $20,000. Well, depending on what your income is for the year and how you file, you're either going to pay 0, 15, or 20% plus, and it potentially, maybe, depending on what your income is, your modified adjusted gross income, another 3.8%. So that's referred to as a preferable rate, because if this growth, this $10,000 that you have growth here, if it was all treated as ordinary income, well, then you potentially have a higher rate, right? So you go, so let's take 94,950. If you were earning 94,950, you would be right about here. You'd pay some at 10, 12, 22, but that same growth could cost you about, let's just call it 22%. It's really not, but let's just call it 22%, probably closer to 20% with the blended rate, which is obviously a lot more than 0. And it's the same with these higher amounts. 94,051 is at 15%. And even if that was the linear, if you were earning $94,051, you'd be really close to the 22% here, and that would still be less than 15, or it'd still be greater than 15%. So that's why they call capital gains rates preferable rates. So 0, 15, or 20%. For a married filer, you can make all the way up to $94,050, $950 without paying any capital gains tax. And anything over $583,750, you're paying 20% and really 23.8% with the Medicare surcharge. So what are the proposed changes? So that's where we are today. In the general explanations of the administration's fiscal year 2025 revenue proposals, this is what came out of the White House in March, and we've been talking about it. There are several changes to the tax code. We already talked about changes to contributions for Roth IRAs, the ability to convert Roth IRAs, and some of the changes around there. Today, we're looking specifically at capital gains tax. So I share this with you so you know where to get it. You can grab, you can see the URL right there if you want to go through this 200 and some page, I think it's 250 page documents itself. But if you look on this is page 80 of the document. We're looking at tax capital income for higher income earners at ordinary rates. So we're going to talk about what higher income earners are. And I had a discussion with somebody about this. Because they're saying, well, geez, these capital gains rates are really potentially going to be out of control. And listen, folks, this is where I think that the first attack is coming. When taxes are going to increase in the future, and we know taxes must increase, I think this is where the first attack is coming, are these capital gains rates. Because they are preferable rates, first of all, and they're viewed fundamentally as rates for the rich, right? Because you've got assets to grow outside of your IRAs. We're talking about non-qualified, right? Not IRA assets, things that grow outside of traditional IRAs or Roth IRAs. You don't get capital gains tax treatment in traditional IRAs or Roth IRAs. We're talking about things that are in that taxable bucket. And that's seen as kind of a wealthy person's problem, right? That $10,000 growth, hey, why not just tax it as ordinary income instead of giving preferred tax rates? So I looked at this the first time and I said, well, listen, somebody has to have $1 million in this proposal, $1 million for this to occur. But listen, if you sell a business, have a significant bonus, especially if you sell a business, you could spend, some business owners spend years and years and years developing a business. Sometimes they don't save money in 401ks or IRAs or taxable accounts. They're really counting on the value of this business. And there's a lot of things that you can do to moderate the capital gains rates around the sale of that business. But this kind of proposal could completely wipe that away and have it taxed at ordinary income. So, again, I think that the capital gains tax is probably the first target to be attacked, not marginal tax rates, but capital gains tax rates. So what's the proposal? Read with me here. Long-term capital gains and qualified dividends of taxpayers with taxable income of more than $1 million will be taxed at ordinary rates, with 37% being the highest rate today. Now, it gets a little worse than that. Remember, right now we're talking that the highest rate is 23.8%. They're saying that, well, if you make $1 million, you're going to be taxed at ordinary income tax rate. Now it reads the proposal, and it does go on to say 40.8%, including the net investment income tax. So remember, that's 37 plus 3.8. But again, it doesn't end there. We have got to go to the footnotes, right? Pay attention to that footnote. The proposal, and here's another footnote, 18. The proposal would only apply to the extent the taxpayer's taxable income exceeds $1 million, $500,000 for married filing separately. Index for inflation after 2024. So it'll go up a little bit after 2024. The proposal would be effective for gains required to be recognized and for dividends received on or after the date of the enactment. So not only capital gains, but also dividends would be if you make over this amount, $1 million, would be taxed at ordinary income tax rates. Now I know, and this was part of the discussion. So we're talking about, sale of a business, big bonus. But the thing that concerns me about these proposals is that it typically starts very high and then creeps down. So could this land at a $400,000 number and affect many more people? I just don't know the answer to that. The proposal would be effective for gains required to be recognized, and I read that already, and for dividends received on or after the date of the enactment. So before I move on, let's go to these footnotes, because that is the rates, right? Now remember, big change from those preferable rates up here that I explained to you. Whoops, where'd that go? These preferable rates over here, now if you make greater than $1 million, it doesn't matter. You're into these brackets here, which are you get taxed much higher at much lower levels. And of course, there's many more brackets involved in here. So instead of you topping out at 23.8, you could go all the way up to 37%. But again, it gets worse than that. Let's go to the footnotes. So here's the first footnote, 18. A separate proposal would first raise the top ordinary rate to 39.6. So up top there, they referred to 37%. Well, that's actually not the case, because there's a separate proposal in this document that would first raise the top ordinary rate to 39.6. And that takes us to 43.4%, including the net investment income. So now we're up to 43.4% for capital gains tax instead of 23.8. Right? Currently, it's 23.8 is the top. So now we're at 43.4. Now, an additional proposal would increase the net investment income tax by 1.2% points above 1.2 percentage points above $400,000. There's a $400,000 number, bringing the marginal net investment income tax rate to 5% for investment income above the $400,000 threshold. Together, the proposals would increase the top marginal rate on long-term capital gains and qualified dividends to 44.6%. 44.6% from 23.8. Now we're at 44.6. So I'm going to say this quite a few times. Do I think this proposal is going to go through? Well, probably not. But I want you to see what is being talked about in Washington. And we are going to see some changes, significant changes to capital gains, as I said, probably before marginal income tax, marginal tax brackets. So that's the increase. Now we also have to pay attention to the transfers. Transfers of appreciated property by gift or on death as realization events. Today, you get what's called a step up in basis. So if I have $1 million of growth in my stock portfolio, and if I sell it today, I realize that growth, and I have to pay capital gains tax, either if they're short-term gains, remember ordinary income tax rates. If they're long-term gains, I have to pay up to that 23.8%. A strategy is, some people say, you know what, I want to pass this on to my heirs. And again, we're not just talking about investment portfolios. We're talking about farms. We're talking about businesses. We're talking about real estate. So and I'm not talking about your personal property. What about investment real estate? So I might want to pass this to my heirs and have that step up in basis. What step up in basis means is that all of that growth gets counted as the purchase price as of the day of death. So if I, heaven forbid, passed away today, I had $1 million in growth in my business and real estate and my stock holdings. Well, my heirs could receive that. Not talking about my wife, other than my spouse, my heirs could receive that as a stepped up basis. My wife could also, but this proposal erases that possibility. Let me explain to you what I'm talking about. Under the proposal, the donor or deceased owner of an appreciated asset would realize a capital gain at the time of transfer. That's the kind of the gist of the whole proposal here. The donor or deceased owner of an appreciated asset would realize a capital gain at the time of the transfer. So whether they donate it to a trust, transfer it to a trust, or transfer it to their heirs, there's some exclusions in here. It's a capital event, right? It's like selling the property, and tax has to be paid at that point. which is completely different than how it is today. The amount of the gain realized would be the excess of the asset's fair market value on the date of the gift or the decedent's date of death over the decedent's basis in net assets or whatever they bought it for. That gain would be taxable income to the donor or to the decedent's estate on the federal gift tax or the federal gift or estate tax return or on a separate capital gains return. The use of capital losses and carry forwards from transfers at death would be allowed against capital gains up to $3,000 of ordinary income on the decedent's final income tax return. And the tax imposed on gains deemed realized at death would be deductible on the estate tax return of the decedent's estate, if any. Gain on unrealized appreciation also would be recognized by a trust, partnership, or other non-corporate entity that is the owner of the property if that property has not been subject to the recognition event within the prior 90 years. For this purpose, a tacking rule would apply to the property received in a non-recognition event from another such. So that's getting a little bit into the weeds. Let's talk about definition here. So I'm reading the definition here. A transfer will be defined under the gift or estate tax provisions and would be valued at the value used for gift or estate tax purposes. However, for purposes of the imposition of this capital gains tax, the following would apply. First, a transferred partial interest generally would be valued as its proportional share of the fair market value of the entire property, provided that this rule would not apply to an interest in a trade or business to the extent that its assets are actively used in the conduct of that trade or business. Second, transfer of properties into and distributions in kind from a trust other than a grantor trust that is deemed to be wholly owned or revocable by the donor would be recognition events. So that means that transfers to trust could also be a capital event, right? So it's just like you transfer your money into a trust. Now you've got to pay tax on that transfer. Hopefully the trust, I didn't see it in here, but hopefully the trust wouldn't have to pay tax on it because they get taxed even higher. So certain exclusions here. Certain exclusions would apply transfers to a U.S. spouse or charity, right? So that's good. Your spouse still maintains the ability to take that step up in basis, at least for the portion. Like if you have a joint account, and God forbid I pass away, my wife receives a step up in basis for the part that's my portion of that account. So that's good that maintains. So transfers to a U.S. spouse or to charity would carry over to the basis of the donor or decedent. Basis of the donor or decedent. Capital gains would not be realized until the surviving spouse disposes of the assets or dies. And appreciated property transferred to charity would be exempt from capital gains tax. All right, so I actually read that wrong the first time. So transfers to a U.S. spouse or to charity would carry over the basis of the donor or decedent. So while it wouldn't be a capital event, the basis would continue, kind of like a gift. The proposal would exclude from recognition any gain. I'm down here. More exclusions. The proposal would exclude from recognition any gain on all tangible personal property, such as household furnishings and personal effects. The $250,000 per person exclusion under current federal law for capital gain of personal residences would apply to all residences and would be portable to the decedent surviving spouse, making the exclusion effectively $500,000 per couple. Finally, the exclusion under current law for capital gains on certain small business stocks would also apply. All right, so that's a lot. We've talked about a lot about that. I'm just going to stop here. Again, I've gotten into the, there's a whole thing about deferral election here. It gets a little, you can see it here, deferral election. It gets a little in the weeds. Pay attention to these. Here are your takeaways. This proposal takes us from 23.8% to 44.6%, given your certain levels of income. Now, I know the levels of income stated in here are high, $1 million a year, but that could easily be realized if you're selling a business, if you have a significant bonus in a given year. And we've seen that. We've definitely seen that with clients. Selling a business, a property. So if you have significant investment properties or if you have a farm or some other greatly appreciated asset, that all gets tied in that calculation. It's not just somebody, it's not just the hedge fund manager who's making $1 million a year. It can be selling the family business, selling the family farm, selling even the family house. If you're above these exclusions we just talked about, the $500,000 or $250,000, or passing on this property at death could also be realized as a capital event. So these are significant changes. Do I think that these changes are going to go through? No, I don't. It gets clearer and clearer every week that this is just really discussion items, right? But again, I want you to see that this is the direction we're heading. Potential limitations on wealth conversions, much higher capital gains rates. If it's somewhere in between 23.8 to 44.6, well, obviously, folks, that's higher. So if it's somewhere near $1 million, maybe it's that $400,000 for single filers, $450,000 for married taxpayers. Folks, that's going to hit a lot of people. And the number one target is likely to be capital gains rates first, then marginal tax rates. IRMA, all those other things around it, of course, are going to generate more revenue. This is something that has to happen because we need, as a nation, more revenue. We may not like it. I don't like it as a planner, for sure, but the gap has to be filled. So it's going to take things like this. Unfortunately, we can't just increase tax rates on corporate tax. There's an increase on tax rates on corporate tax also in this proposal, but the amount of revenue produced by even doubling corporate tax rates wouldn't move the needle. So I don't say this to scare you or to concern you. I say this to make you aware. These are the things that we have to be paying attention to. This is what the discussion that's coming out of Washington. This is the reality of what we're looking at. I think that we're going to see more proposals like this from both sides of the aisle, folks, coming down throughout the years till we get to that crisis point, probably around 2030 or so, where we have to do something. I don't think that Washington is going to be insightful enough to make these changes well ahead, because they're all concerned about their reelection. It was actually, not to be political, but I was actually quite surprised to see this aggressive proposal come out in an election year. But maybe that just tells us the importance of it all. So I hope that was helpful. If you have any questions, you can reach us at questions@attleborowealth.com. That's questions@attleborowealth.com. And there is no webinar next week. And then we switch to Wednesdays. We'll see you on June 5th. Have a great week. I hope that was helpful, and we'll see you soon. Take care.